Hello, my name is Timothy Leroy Sr., and I'm the creator of the Smart Money Manuscript. But Tim, what is the Smart Money Manuscript? The Smart Money Manuscript is your roadmap to financial freedom. Inside this powerful course designed to transform your financial future, I've meticulously condensed over 1,000 of my public YouTube videos into 40 highly efficient lessons that span just 2.5 hours. This course is strategically designed into 4 phases to help guide your learning in the most logical and effective way possible. Phase 1 lays the groundwork, covering essential financial literacy like budgeting, banking, and taxes. In phase 2, you'll move beyond the basics, learning about brokerage accounts, figuring out how much you need for your own individual retirement. You learn about how to do fundamental research on companies, and you'll also learn how to conduct technical analysis by looking at stock charts. Phase 3 empowers you to build a robust portfolio and leverage your capital using advanced techniques like options and futures, and it also teaches you the importance of backtesting your strategies. Finally, phase 4 takes a deep dive into the advanced ICT concepts, giving you a professional edge. Each lesson includes a short quiz to help solidify your understanding. By the end of this journey, you'll have the confidence and tool that you need to make intelligent investing decisions, manage your money without fear or ambiguity. So if you want to be a long-term buy and hold investor, if you want to be a swing trader, if you want to be a day trader, if you want to trade stocks, if you want to trade options, if you want to trade futures, the Smart Money Manuscript is for you for $69.99. Yes, $69.99 for all of this here. Good evening, everybody. How y'all doing? Can y'all hear me okay? Hello, hello, hello. Yes.
Yes, we can hear you.
All right. So I was in the middle of something here. We're gonna get right to it. Shout out to everybody that's in here, man. I see Marco in here. See Jim in here. I see Steve up in here, G Ferd, Rhonda Green. I see Deborah in here. What's going on to everybody that's in here? Hopefully y'all doing all right, man. Hopefully y'all doing all right.
All is well.
Rhonda, plug your book for the 2 people we got looking at the thing.
Oh, I thank you.
Tell the folk how they can get your book.
You can always visit rhondagreen.com or Amazon to purchase any of my books about relationships and dating. So hopefully we can all find love in 2026.
Yes, sir.
But make sure you're also following Tim, because we're not falling in love with anybody who's broke.
Rhonda, hold up, Rhonda. Don't start. Hey, I'm a what they call I'm a red pill man. Don't start sound like no modern woman now. Don't start sound like no modern woman, no baddie. They call me a red pill man these days. Hey, shout out Rhonda Green, man. Rhonda Green is a person that's walking in her purpose. I love people that's walking in their purpose. I love people that's authentic. You know what I'm saying? A lot of people a lot of people be too disingenuous. It's like they pretend like 2 things can't coexist. You know what I'm saying? They try to pretend like, oh, yeah, it's toxic masculinity, or you're just trying to be too manly, women trying to be too manly, or men trying to be too, they act like, you know what I'm saying? You can't understand roles in life, right? You know what I'm saying? So I like genuine people. I like people who, you know what I'm saying? And I try to support people who deserve being supported, man. So, and I don't always know how to express what I'm trying to say, but if y'all get what I'm saying, if you know me, rondagreen.com/before the butterflies. Y'all go support my sister, man. Y'all go support my sister. Um, and you ain't trying to take no broke man. Go support my sister. Brother said, follow Tilko, we ain't trying to date no broke man. Brother, what a man broke, but he got a good head in the shoulder. He getting himself together.
As long as he going places.
So don't you ain't talk don't it's not the fact that he broke, it's the fact that he a pookie. You don't want him to be dating no pookies. Like he ain't
Right.
got no ambition. Hey man, uh oh, I forgot to put the link in the chat. Let me put the link in the chat. Shout out Rhonda Green. Shout out Rhonda Green. Is it Rhonda? Are you self-published or are you working with a publisher?
Self-publish because I want
Self-published,
all the money.
self-published. So y'all, you know what I'm saying? I ain't got no big channel, but I show love to people that deserve it. Self-published, you know what I'm saying? Support the system, man. Support the system. If this your first time tuning in to Tim's Tidbits, please allow me to say welcome. If it's not your first time tuning in to Tim's Tidbits, I still want to say welcome and give you a nice hearty well, thank you for always tuning in to Tim's Tidbits. If you don't know who I am, my name is Timothy Lee Rogers Sr., aka Aranya Grande. That just be big spot if you don't hablo español. And you're in tune to another episode of Facilitation February. What is Facilitation February, Timothy? I'm glad you asked that question. Facilitation February is when we're going through my old playlist, The Art of Reading Price Action, and we're going through video by video, and I'm offering a deeper dive into the concepts if I see that it may be something that I can expound on a little bit more, something that I got a better understanding of now that that series is like over a year old, because it's always something to learn when you're studying price. And this is just a way of me trying to help the gang like really, you know what I'm saying, fortify the concepts in their mind, because I understand everybody don't learn at the same pace. So as a mentor, right, I'm always trying to find different ways to help the community, right? So just going back over the material, going through and either re-explaining or taking a deeper dive in the different concepts. Now, we're doing this Monday through Friday at 8 p.m. every night for the month of February, right? At the end of once we watch the video, I'll deep dive inside the video if I need to pause and go deeper on the subject or expound more. Then at the end, I'll take questions from the gang. Now, I'm not paying attention to any chats. I'm not looking at the YouTube chats. I'm not looking at the Zoom chats. But if the gang got questions they want to ask at the end, I'll open up the floor for questions. If you want to know how to be a part of the gang, there should be a link in the description below that says join the Discord. Do not hit the join button on YouTube. The join button on YouTube does not get you in the Discord, right? The Discord is $50 a month to be a member of the Discord. You do not have to join the Discord. This is not a pitch for you to join the Discord. This is just something that I'm doing for the gang, and I'm just putting it out publicly on the YouTube too to try to reach as many people as possible. All right. Now, without further ado, let me share my screen with you. This ever since I got my new system, I promise you, I have to actually be on the Zoom window. Why did my trader view open up? I have to be actually on the Zoom window before I can hit my hotkey to like share my screen. If I'm not on, you know what? I could use my what's the name? I got Zoom inside here. Zoom controls. Okay. Thought I could. It's not. Oh yeah, it turned my camera off. Oh, there it is right there. Share. Boom. Look at that. All I had to do was just use my what's the name? Stop sharing. Share. It's all over it. Look how that's working out. Unmute the mic. Man, shout out to the stream deck, man. Y'all give it up for the stream deck, man. Give it up for the stream deck. Nah. Watch it not be sharing the sound. Watch it not be sharing the sound. Let me make sure it's sharing my. Oh, God dog it, Tim. Come on. It wasn't sharing the sound. So it doesn't automatically share the sound when I do it like that. But y'all give it up for the stream. Yes. All right, let's get to it. Shout out Yolanda who popped in since we've been talking about this tonight. We're not talking about before the butterflies anymore. We're talking about displacement. Displacement is the topic that we're covering tonight. If you are on Instagram,
greetings, salutations. How young I say, yo, how have you said it, yo, next?
YouTube.com/the-new-TLR so that you can see the screen and join the class, right? The IG, I just got it up here just in case somebody pop in. YouTube.com/the-new-TLR so you can join the class. You can see the screen. You can, interact with us like that. Let's get to it, little Timmy Rogers.
Back in the woods, I'd like to welcome you to another episode of Le Art of Reading Price.
Let's get to it.
The art of reading price action and talk about displacement. Now turn your attention over there. Not on me, over there. Displacement.
What is not invisible.
The displacement? Displacement is an aggressive
in YouTube
one-sided price move. One-sided, right? If you notice here, there's an arrow pointing up at this one-sided price move. But what do we call displacement? We don't call it displacement. What do we call it, gang? I'll give you a few seconds to tell me what we call it. Drop it in the chat within a few seconds. Few seconds up. We call it pay-yow! That's right. We call it pay-yow, baby. We don't call it displacement. Now, when you're looking for displacement, it's a few things you want to focus on. What do you want to look for? First thing, and the most important in my opinion, is that you want to make sure fair value gaps are present. Okay, fair value gaps are present. You want to make sure it's occurring on the higher time frame. Everything is driven by the higher time frame when it comes to the ICT concepts. Why is that? Because we want there to be an evidence of institutional sponsorship. Hold up, Tim. You introduced a new phrase to me. What is institutional sponsorship? Well, I'm glad you asked that. Well, let's talk about it. But you do want to see evidence of institutional sponsorship during the payout. So, institutional sponsorship. How to identify it in setups. This is straight off of Michael's slide. You see there, ICT monthly mentorship. You can find this in month 3 somewhere. I think it's video 3 of month 3. But if you want to watch his video of institutional sponsorships, go over there and do that. He does a great job. Now, institutional sponsorship for long setups and for short setups. I'm just going to paraphrase both of them or I'm going to combine both of them as I speak because you just flip it on his head. Everything is the reverse in these concepts. Institutional sponsorship and long setups. Higher time frame displacement. It can be coming in the form of reversals, expansions, returns to fair value. I know you're thinking like, Tim, you're saying a lot of words that I don't really understand. Don't feel bad. It's just a whole bunch of saying the same thing over and over. Intermediate term imbalance in price. Right? Well, Tim, what is that? A move to discount or premium if you're bearish, or sell side or buy side liquidity runs. That's the move to discount, right? That's just a return to fair value, right? A move to discount, that's a return to fair value. Meaning when you get a large expansion and you do a retrace, that's a return to fair value. Your expansion is moving away from an area, and then when you return to fair value, you just retrace or move back to discount or premium, depending on if you're bullish or bearish. And then running sell stops or running buy stops. That's all it is. An intermediate term imbalance.
Was my screen pausing just then? When I was, because I was doing something on the computer and it looked like it was pausing. Was it pausing? Anybody? Can y'all hear me?
I didn't see it pause.
Oh, okay. All right. Because I was doing something and it looked like it had froze for like a really long time. That's what, okay. All right.
In price. And why do you call it an intermediate term imbalance in price, Tim? Well, I didn't call it that. Michael called it that. But in my humble opinion, an intermediate term imbalance is price is just price coming to what we like to call around here an anticipatory reactionary point. It's intermediate. You want it to be on a higher time frame than what you're looking at currently, right? Higher time frame. Just think about it like that. Anticipatory reactionary point. When you move to discount or run sales stops, you're coming to an anticipatory reactionary point, right? Short-term buy liquidity above the market or sell liquidity below the market. Why? Because that is the place where it's ideal for pairing your exits to your trades. So if you get in when price moves back to a discount, or if price runs sell stop, or if price moves back to a premium and price runs buy stops and you get in, you want to be looking for somewhere in price where you can pair your or offset your position. That's a swing high or a swing low, in case you're missing it. Right? And then for the intraday traders, time of day influence, like the London Open, low of day, or the New York low formation, right? Open, high, low, close. Remember open, high, low, close? Whenever you're looking at open, high, low, close, if you're bullish, you want to be buying where? In a discount, ideally below the open. If you're bearish, you want to sell where? In a premium. If you're bearish, ideally above the open. Open, high, low, close, fair value gaps, institutional order flow. Pang-yow! See how they all tying together? They all tying together? I told you. Blocks on blocks on stacks on stacks on blocks. Don't forget the other stuff. Keep bringing it along with you while you're studying. Now, this right here is another slide. All the slides pretty much going to be straight from ICT's, from Michael's ICT presentation. Now, in this slide over here, the daily chart shows price dropping down below an old low. Right, see this old low over here, where sales stops would typically be pooled. Why do they call it that? It's a liquidity pool, because all of the sales stops are down here pooled up under there. It's just a bunch of market orders sitting down here, some limit orders, but mostly market orders sitting down here waiting in a big pool of orders. Okay. The aggressive trader can at that time look for lower time frames to show similar price action in the form of a low being violated and a long can be taken. Remember what I said, price is fractal. Now this is all talked about institutional sponsorship right here. These are the clues that you look for to see if institutional sponsorship is present. Now, forgive me for not saying this in the beginning. Institutional sponsorship is, in its simplest form, a willingness to protect an underlying price move. Meaning, if you anticipate price to move from this low after it sweeps this low back up to this high, what is the algo leaving in place to protect this implied move up? That's what institutional sponsorship is in its most basic form. Now let's.
All right. Don't want to gloss over this right here. Don't want to gloss over this. Now, for when we're talking about implied moves and institutional sponsorship, this is where a lot of people start to get confused about the fractal nature of price. And I say a lot of people because when I first started trading ICT concepts, this is what used to bust me in the head all the time. Okay. So when it talks about the aggressive trader at this time looking for similar price action, once this liquidity is taken right here, now the higher time frame is just coming into the ARP. It's coming into sweeping the sell side. We're anticipating a move back in this direction based off of this sweep. Now, what you can do at this time, once we interact with this low, is go to a lower time frame and start looking for the exact same thing, but on a lower time frame. And when you trade that lower time frame, you're only going to trade it, but you're not going to try to trade the lower time frame at this time all the way back to here, right? You may not even try to trade it back to here, which could be probably possible if you got a nice low resistance liquidity run into this. But your thing is you're trying to trade it within the realms of, now I'm on a lower time frame and I'm looking for something similar to this entire fractal of price on this higher time frame on a lower time frame over here. And your lower time frame, the high may be the high of this candle right here. Did my light just go out? Oh man, don't tell me. I was adjusting some stuff the other day and I think I done messed up my light because this plug acting like it's got a short in it. Anyway, the high of the fractal on the lower time frame may be this candle's high right here, but this entire fractal may be set up with inside of this candle right here, and you may be trading back to that high on a lower time frame. So that's why a lot of times people get misconstrued and say, oh, it's not working, I keep getting stopped out, because you're trying to enter here now and go all the way back to here, or you're trying to enter here now and go all the way back to here. But if you're trying to engage with these highs and lows, you want this time frame to give you a reason to enter in at a discount if you're not a turtle soup trader. So if you was a turtle soup trader, soon as you come below this low, now you're entering here based off of this time frame, and you're shooting for this high, this high, this high, right? But you're entering off of turtle soup. If you're looking for displacement,
and you're trying to trade off of a breaker or a fair value gap or a order block or anything like that, this time frame has not given you any displacement yet. It has only attacked the lows, right? So you have to understand, what time frame am I engaging on, and what is the higher time frame versus the lower time frame? Where are we in price delivery and order flow based off the higher time frame and lower time frames? If I confused anybody on that, write down your question and I'll address it at the end. All right, carry on. Let's continue. You have a bullish order block sitting right here. Okay, here's your bullish order block. And if you're anticipating to get in on this bullish order block, what do you need to have in place above you? Remember, we said it need to be some buy side liquidity in the market if you're bullish, sell side liquidity if you're bearish, some buy side liquidity in the market where you can pair your orders. These are all signs pointing that institutional sponsorship may be getting ready to rear its beautiful head. So we got a run on sell stops. We got a bullish order block created when we traded up above that down close candle after hitting an anticipatory reactionary point. Okay. Now, once you get the pow, there's your higher time frame displacement. And you now know that institutional sponsorship is involved. How do you know that? One, the displacement is present because we have a heavy one-sided move that leaves imbalances. You got imbalances when you take off. So you're creating bissies on your way up or creating sibbies on your way down. There's your displacement. Now, your clues that you had, you came to an anticipatory reactionary point. You got a pang out. You attacked some short-term buy side in there. Remember? Those everything. Let's go back. We came to an intermediate term imbalance, right? Not only did we move to a discount, but we ran sell side. Okay, we were looking for short-term buy liquidity above the market. Why? Because it's ideal for pairing long exits to. Move back down into a discount, coming down here. We ran sell stops. Okay, and then we attacked buy side with a pow. So now we got displacement, expansion with imbalances. That's your displacement, a heavy one-sided move, and it's creating fair value gaps, and it's on the higher time frame. Why do we want it to be on the higher time frame, Tim? Because it takes a lot of money to move the higher time frame this far in one direction. That's a lot of institutional money going to work to move. These are daily candles, by the way. It takes a lot of institutional money to make a move like this. Now, we're not going to chase price. This has nothing to do with it. I'm just throwing in an extra little bone for those who want to sneak off and try to trade right now when you shouldn't be. You're not going to enter right now. You want to wait for a retracement back down into the discount, because we buy in discounts and we sell in premiums. But what is price? What has the... Pause it right there, right? So as we see, what I was saying before I paused it before, when price came here below the sell side, right? If you were a turtle soup trader, you would have got long, you would have did a turtle soup buy as soon as you went under. But if you're waiting on displacement
for this time frame, right, the displacement had not happened. Now the displacement is there, and now that you got the displacement, right, you want that. What do you want that displacement to do? You want that displacement to give you a break in market structure, a market structure shift, which it did. It attacked some liquidity, right? So you went from external liquidity to external liquidity, right? What is that? This range right here, from that high to that low, or that high to that low, whichever one you use, their relative equal highs, right? So we come from this high to this low, because that's the, well, this the latest one, but yeah, we're coming down. We went to external liquidity. We came back up. We came to external liquidity, right? Symbolizing a shift, right? We've gone from bearish to bullish, right? We got a change in the state of delivery, right? We got to change. We've traded back above these down closed candles over here. All these down closed candles that was taking us down into liquidity here, right? This is our order block that took the liquidity. That's our change in the state of delivery right there. Okay, so we got to change the state of delivery. We got to break in market structure, right? We got our heavy displacement, and this is all on this higher time frame, right? So now that the higher time frame has given you institutional, show you evidence of institutional sponsorship. Now, the difference between looking for entries on the lower time frame at this level and looking for entries on the lower time frame at this level is that now the higher time frame is showing you I have expanded and I have retraced and I'm back in a discount ready to buy. So now you're looking for price to continue to higher time frame targets. Right over here, you're trading it as what I like to call a first touch, where we're just creating it, right? You're in tune with the algorithm, you see it do something, but you like we talked about before, you would be coming here, right, and trading back to maybe that high when this first happens, right? If you, like I said, if you get lucky, it'll come back to this high, but you're not trying to force it all the way to here. Over here, once the higher time frame has given you the sweep, the expansion, and the retracement, now when you're looking at your lower time frame here, this is going to give you the opportunity to get the huge moves from here to there based off the lower time frame, because now the higher time frame is at the point of, okay, it's time to buy now, because I've manipulated, right, expanded, retracement. Now you're getting in on this distribution leg on the higher time frame. Okay, carry on.
Algorithm left in place to let you know that a move back up will be protected. You have, in this case, a bullish order block down here. You got imbalances here. You got a lot of PD arrays that stacked up at a key level at your anticipatory reactionary point down here. A lot of confluence of PD arrays to let you know that the institutions are going to protect these lows now. Why? Because their stops are below there. They've already taken other people's stops, and now their stops are down here, and they're going to protect these stops with the little clues left behind in price. And this is when you're trying to get in. Whatever your entry model is, you shouldn't have one, because you're just a mentee and you're just learning how to read price right now. And just like that, we move back up, and once we take the new buy stops, the institutional sponsorship is letting you know that, hey, it may be safe to continue up to this. Why? Because we've moved up to what? Equilibrium. Right there. Equilibrium is what? Fair value. Fair value? I saw that before. I saw it where? Back here. When it said when price moves to, returns to fair value. Higher time frame displacement or return to fair value. We've returned to equilibrium and we're at fair value. So there's a possibility that the institutional sponsorship is going to continue to protect their sell stops and continue to attack the buy stops. Let's get into one other thing that you want to watch for institutional sponsorship and with displacement. When you are bullish or bearish, you want to see how price reacts. By the way, this is the same price move, but just on a lower time frame. You want to see how price reacts at opens, at discount or premium if you're bearish, at lows. You want to see how price reacts. If you're bullish, you want to see price continue to displace if it drops below an open. You want to see price continue to displace if it drops into discount or goes into premium if you're bearish. You want to see the displacement continue at key price points to let you know that institutional sponsorship is still supporting the move. If you fail to see displacement at key places, or if it displaces in a different direction than you expect, you may be wrong. For example, the blue lines on this chart, they represent the midnight open. As you see, whenever price comes below midnight here, we get displacement. Come below midnight there, we get displacement. We pull back into a discount, we get displacement. All right? We pull back below a low, right? We get displacement. It's like price is continuing to get displacement when it drops to key price points, below opens, in discount, above opens, in premium, depending on if you're bullish or bearish. So you want to continue to see the institutional sponsorship involved with the displacement. So with displacement, you want to make sure fair value gaps are present. You want to make sure it occurs on a higher time frame. And then on a lower time frame, you want to see that displacement continues if you drop below a low, if you're bullish, above highs, if you're bearish, below opens, if you're bullish, above opens, if you're bearish, if it pulls back to a discount, if you're bullish, if it goes up to a premium, if you're bearish. Anytime price hits these key price levels, you want to see displacement happen to let you know that institutional sponsorship is still on your side. And with that, that brings us to your favorite part of the episode, le homework. For today's homework, I want you to go back through price and find examples of displacement on the daily chart. Right? And once
Y'all see the homework? Y'all see what the homework is? Like I said, back when I was using the ES chart. So you can use the ES, you can use the NQ, you can use whatever chart you want to do the homework. But like I was saying, you want to see price. You want to be patient enough to wait for price to set all the way up on the higher time frame before dropping to the lower time frame. And it, because once you do that, now on the lower time frame, now you can trust the distribution leg, because the higher time frame has done the higher time frame is in that portion of price delivery. We've got the consolidation, expansion, retracement, and now we're delivery. We're in that distribution leg of that delivery. We've done the consolidation, expansion, reversal, retracement, and now we're in that delivery leg, that distribution of the range. That's why you want to wait until it's more ideal to wait until price that's the displacement, and wait for price to come back here. This is the ideal time to drop down to your lower time frame and start looking for an entry, right? Or if you're trading off of the higher time frame, this is when you want to enter here. But
once you enter there, be it on a higher time frame or lower time frame, once you enter, now you want to see price continue to show you that I'm on the right side. And this is how you can start to manage your stop placement. This is how you can start to manage your stop placement, because let's just say if you entered off the higher time frame or lower time frame here, right? Once price moves up, comes back down to a discount of this range, right? And then we expand out of that area. Now you can start to manage your stop, because now we got this low here that we have left safe. And then now here we got this low here where we expanded away, breaking structure. So now that low should not be touched. And now you can manage your stop and bring it here, right? Once we leave this area here, we've come back down to a discount, right? We've come back down to a discount. Notice we rally up. We didn't take that high. So if you would have moved your stop before taking this area and moved it here, you would have been stopped out, right? You want price to give you that, show you I'm done with this area, give you that shift, right? So now that you got that shift here, now you can come back and manage your stop, move your stop there, right? You don't want to choke off your trade, right? You don't want to choke off your trade, and you can use it. You can use the idea of, okay, institutional sponsorship is still involved, so they're going to protect this low. Now it becomes a fractal thing, right? Just like on your higher time frame, where you're saying, what is price put in, what is the algorithm putting in place to protect this low, right? We're putting order blocks there. We have fair value gaps there, right? You have PD arrays to show you that price is still protecting that low or high. And so it's just a fractal thing now. What is price put in place? What is the algorithm put in place to protect this low, right? We have order blocks here, right? The last, you got a consolidation and then expansion, right? Right, the last down close candle at or near equilibrium after the expansion, you got an order block there. You have fair value gaps here, right? You got all the same information. So now this low should be protected based off this order block, based off these fair value gaps. Price, if when it comes back down to a discount there, we rally up and make relative equal highs. Then we come back down and get a manipulation of a low, but we don't take out that low that's protected, right? So when we don't take out that low that's protected, once we come back up and take out this high, now it's back to the same thing, right? Now we got us a low that should stay protected. There's an intermediate term low down there. That low should stay protected now, right? You're just looking for the evidence of institutional sponsorship over and over and over again, even after you're in the trade. All right. And with that, that brings us to the end of this episode. Do we have any questions from the gang? Going around the table. Marco, you got anything?
No, sir. Thank you.
All right. Deborah, do you have anything?
No, I'm good.
Jim, I'm the biggest bird. You got anything, Jim?
Nope, I'm good.
All right. Do y'all know why I always saying I'm the biggest bird whenever I say Jim name? Who?
Sesame Street?
No, not Sesame Street.
Oh, what is?
Cause his username used to be Jim Big Bird. It used to be Jim Big Bird. I don't know if it was Discord. I don't know. I can't remember where it was. But when Jim first came in the gang, his username used to say Jim Big Bird. So now that's why I would be like, I'm the biggest bird. I'm the biggest bird. It used to be like a little meme with a bird. They used to be like, I'm the biggest bird. I'm the biggest bird. Steve, you got something, Steve?
No, I'm good, Tim. Thank you.
All right. Rhonda Green.
No questions.
Yolanda, you got anything?
Yeah, I do. When like you said, we're initially looking that was a first touch. I know.
I,
And
I ain't gonna
so
I ain't gonna
after
let you
we
I ain't gonna let you
take
keep talking.
out
I ain't gonna let you keep talking. We
that,
can't hear nothing you saying.
I know we
We can't
expect
hear
that
nothing you
immediate.
saying. We can't see. All I heard was we can't hear nothing you saying.
Uh-oh.
I heard an old clip. Say something now. I heard an old clip.
Can you hear me now or not really?
Yeah. I hear you good now. You good now.
Okay. I know we talk about that first touch, and
Uh-huh.
after we take out that mid-range high that sent us down, we
Mm-hmm.
expect a retrace.
Mm-hmm.
I guess that we have a new range now on that bullish one. Do we really still not really still we still expect it to come back and test the order block below that 50%? I guess no matter, it's still a discount, right? So we
Now,
should expect.
when you specifically talk about the order block, if it's coming back to an order block, then what does that mean? During that period of time, what kind of conditions are you in? If it's coming all the way back to the order block, do you know?
High resistance.
resistance.
High resistance. So if it's
Okay,
coming
that's the high resistance.
if it's
High
coming
resistance
all the
maybe.
way back to the order block, you just know during that time it was in high resistance. So you're not anticipating it coming, excuse me, coming all the way back to the order block. But if it comes all the way back to the order block, then it is what it is. You're just looking for reasons to buy once the higher time frame comes back to a discount. You follow what I'm saying? Like, for example, in here, okay, if you were buying off of this fair value gap right here, right? If you was buying off this fair value gap right
Okay,
here,
We
sir.
can't see your screen.
oh, okay. Thank y'all for not letting me go through that. All right. So if you're buying off this fair value gap right here, okay. So now, as we see here, we got, in this case, this candle is lower than that one. So this would be where your stop would be there, right? And then, like we always say, our safe stop is below the swing low, right? So if you're buying off of there, we start to go up, but then we get a retracement all the way back down to the order block. So in this case, it looks like, I can't hardly tell, but it looks like you would be safe under the low, and you would definitely be safe at the safe stop there. Okay. But that's a lot of drawdown to sit through, especially when it starts going in your direction. But it doesn't come back to that low there, right? Because in this case, I know Michael teaches that first candle, but most time you're looking for that first candle to have a lower low or higher high than the middle candle, but you're looking at the low of the fair value gap or the swing low that the price leg that is in, right? So you're looking to trade the ICT concepts in low resistance liquidity run conditions. Okay. But even in high resistance conditions, sometimes you may sit through some drawdown, but if the algorithm is really algorithming, right? A lot of times you'll go through drawdown, but you will still be safe. All right. So you're not looking for it to come back to the order block, right? As deep as this here. But if it does, it doesn't change the idea that, hey, I'm still bullish. Hey, it's just high resistance, and I may have gotten stopped out at this time. You know what I'm saying? I may have gotten stopped out if it does come all the way back to that order block. So, but that's why I say, when you're looking at trading it on the first touch, you're not trying to force it like too far. And even when you're trading it on the retracement, right, you understand this is what the algorithm should do. Even if I get manipulated out during this high resistance, it's not changing my my thesis. It's not changing my bias, right? If I got long here, and it came all the way back to the order block and I got stopped out here. Now I can take this opportunity to drop down to a lower time frame to look for a entry where I can put on less risk with more reward to like help me recoup what I just got stopped out on. That makes sense. I know you were saying anticipating coming back. We're never anticipating it coming back to the order block because we always want to see low resistance liquidity runs. But if it does, then we, you know what I'm saying, we know how to react. We know how to engage accordingly. While we waiting on Yolanda cheap cell phone, Charmaine, do you got anything?
No, no questions. Thank you.
All right. And then what was that? G-Ferd? G-Ferd was down there?
Yeah, I'm good, man. Thank you.
All right. Give Yolanda about 30 more seconds on a cheap cell phone, and then we're gonna go ahead and call it.
No, I understand. Hopefully you hear me. Thank you.
Yeah, I heard you that time. I heard you that time. Tell my little partners I said what's happening. I know they probably sitting there listening. Deborah, tell my dog Sherwin I said what's happening when you get home from work. Because you got on RN Deborah picture today. So I know you probably, you know what I'm saying, sneaking and listening to this while you're sitting at the nurse's station instead of listening to the monitors from the patients in the rooms. Tomorrow night, we gonna be what are we looking at tomorrow? Tomorrow is internal liquidity and external. Excuse me, man, a Fresca came back with a vengeance. Internal liquidity and external liquidity is what we're going to be studying tomorrow. All right. All righty. Do me a favor. I forgot to say this tonight. Do me a favor. Hit a like for the algorithm. And if you're not subscribed to the channel, what is you doing? Go ahead and subscribe. If you want to be a part of the gang, link is in the description below. $50 a month. Do not hit the join button on YouTube. That does not put you in the Discord. What's the day? Monday? Yes, today's Monday. Tomorrow's Tuesday. Nothing going on tomorrow. See y'all at 8 tomorrow for another episode of Facilitation February. If this was your first time tuning in to Tim's Tidbits, thank you and welcome. But until the next time I decide to get on Al Gore's internet and share my thoughts on this thing that we call price action, y'all, oh yeah, I forgot to tell you who I was. It's your boy Timothy Rod Sr., aka Run Your Gun Day. Y'all be safe out here in these trading streets, man. Gone.